The year 2025 looks to be another good year for the stock market, despite concerns about new trade policy, aging of the AI story, and what the Fed is doing about interest rates. Where will markets head in 2026? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update. The date today is December 15th, 2025, and today we'll be discussing what we believe to be the main factors driving stock and bond markets today and going forward. My name is Paul Latta, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin the presentation today with a discussion about recent market action, stocks, bonds, and other assets. We'll then look at the macroeconomy to add some support behind the market discussion, and then we'll move to a microeconomic viewpoint and look at key industry-specific drivers. Then we'll conclude with some longer-term observations about the investment landscape. The S&P 500 is up 18.8% year-to-date through December 12th, as shown on the left, and we seem to be putting that volatility from March and April behind us now. The chart on the right shows the S&P 500 is up 102.8% over the last 5 years, and that there have been a couple of pullbacks along the way. The bond market is up 7% year-to-date, as shown on the left, with much of that gain in the late summer as the Fed implemented its first rate cut of the year in September. Over the last 5 years, bonds are down 1.8%, as shown on the right. The bond market is still below its 2020 highs when central banks around the world cut rates to near zero amid the COVID pandemic. The Fed lifted rates high in 2022 and 2023 amid a post-COVID inflation surge. But as inflation softened, the Fed has been slow to cut rates in 2024 and early 2025. The Fed finally began rate cutting in the recent months, with a quarter-point cut in each of September, October, and then December. However, at the most recent rate-setting meeting just this past week, the Fed hinted at slowing down the pace of rate cuts in 2026. The blue box on the top row of the table here shows that Fed funds futures are now implying a 75.6% chance that the Fed will leave rates unchanged at the upcoming January meeting, which will be at the present rate of 3.5% to 3.75% as shown. The Fed is acknowledging signs of labor market softness as well as signs of possible secondary waves of inflation, so the Fed is intentionally going slow with rate cuts. As a reminder, this table changes every day with new information on signs of economic strength or weakness as well as signs of inflation weakening or strengthening. This is a dynamic process. Most global central banks have been cutting rates since inflation peaked in 2022, but with variations in timing and levels. The U.S. was late to join the rate-cutting trend at other central banks. This mainly reflected new U.S. tariff policy that lifted fears of stagflation, thereby putting the Fed on the sidelines when other central banks were cutting rates. There has been much discussion about Trump appointing a new Fed chair in light of the fact that Jay Powell's term expires in May of next year. Indeed, Trump has been quite vocal about the Fed not cutting rates more quickly. The chart here shows the betting markets at Polymarket have Kevin Hassett as the leading contender, though Kevin Warsh is rising rapidly. Christopher Waller and Scott Bessent are also possibilities, though both appear to be dark horse candidates at this point. Indeed, there is still a number of months to go, so an as-yet unnamed dark horse is also very possible. While the new chair will change the face of the Fed to the media, we do not believe the Fed policy will change much regardless of who becomes the new chair. Recall, the rate-setting committee involves independent voting from the 12 voting board members. The chair is just one vote. Putting in a new chair that has a radically different opinion from the existing chair will not really change the other 11 votes. From a policy standpoint, the old 1960s song lyric is apropos. Meet the new boss, just like the old boss. When thinking about headwinds and tailwinds for stock market investors, the Fed is right at the top of the list. Bulls will cite the fact that more Fed rate cuts are headed our way in 2026. Bears will not really disagree, but will point out that those rate cuts are likely to be few and far between given the Fed's inclination to go slow amid tariff uncertainty. Bulls will point out that inflation has dropped from near 9% in 2022 to today's 3% level. Bears will note that inflation has actually lifted from 2% earlier this year to 3% today, and tariffs keep pushing inflation higher. Bulls will highlight the strength of the service economy as well as the great corporate earnings. Bears will highlight the softness in the labor market and weak consumer sentiment. Bulls will highlight that while AI stocks may have elevated valuations, the other sectors in the stock market are quite reasonable, as are stock markets overseas. Bears would point out that AI stocks constitute an enormous portion of the overall U.S. stock market, so cap-weighted valuation of the overall S&P is actually quite high. Lastly, bulls would highlight that the stock market is still one of the few investments that benefit from capital formation related to innovation, artificial intelligence, gene editing, electric vehicles, GLP-1s, etc. Bears, however, would also point out that stock markets are also exposed to exogenous factors like wars and geopolitical issues such as those in Venezuela, Russia, China, and the Middle East. This is a chart of the S&P 500 over the last 10 years in blue and the valuation of the S&P 500 using the price-to-earnings ratio in purple. As you can see, the S&P 500 has done well over the last decade, lifting just over 300%. Some of that is due to elevated valuation, as shown in purple. The present price-to-earnings ratio, or PE ratio, is 22.7 times, which is indeed near the upper end of the 10-year range of 14 to 24. The elevated valuation does not mean a correction is imminent, but it does reduce longer-term return potential for new investments into the stock market today. Stock and bond valuations have converged in the last 2 to 3 years. This chart looks at the earnings yield on the S&P 500 compared to the yield on the benchmark 10-year Treasury. So whichever line is higher, in theory, is the better value. Stock and bond valuations used to trade in close tandem back in the 1980s and 1990s, but after the dot-com bubble burst, bond valuations escalated well above stock valuations. That lasted until the bond bear market of 2022, the worst bond market in over a century. And today, bonds and stocks are again on par with each other. The sector breakdown in 2025 to date seems to favor those sectors that are dominated by the large technology names, the fan mags, Facebook, Meta, Apple, Nvidia, Microsoft, Amazon, and Google. We've also seen some of the aerospace and defense names like Boeing and RTX perform fairly well this year. In contrast, the real estate sector remains the weakest sector year to date, mainly reflecting the higher rate environment. The first half of 2025 saw a notable improvement in the market breadth, but in the back half of the year that market breadth is again narrowing. Recall market breadth in 2023 and 2024 dropped to a 40-year low as over half the gains were driven by just 7 stocks, the so-called Magnificent Seven. The big driver then was the AI story and the rise of ChatGPT and other large language models. The slightly narrower market seems likely to continue, but at a fairly modest level and not like the extremes of 2023 and 2024. The style factor breakdown year to date has yielded few surprises. In the bear market of the first quarter, the market was led by defensive styles like low volatility, value, and income. And with the bull market in the last 3 quarters of the year, the market is being led by the more aggressive styles like high beta and story stocks. The table on the left shows stock market performance by country. It's ranked by year-to-date performance in the column on the right. While the U.S. stock market gain of 18.9% year-to-date appears to be a solid year for the U.S., the performance is actually fairly weak compared to the rest of the world. Indeed, the S&P 500 is shown here in 15th place, not a great showing on a table with only 20 entries. The relatively weak U.S. performance mainly reflects the loss of momentum in the AI trade, especially in the first quarter, but it also reflected the isolationist tariff and trade policies, which has pushed capital overseas and weakened the U.S. dollar. The 2 leading stock markets, South Korea and South Africa, both outperformed due to heavy concentration in industries that outperformed. Computer chips for South Korea with its Samsung and Hynix corporations, and precious metals for South Africa with its Anglo, Ashanti, Goldfields, and Harmony Gold corporations. Some stock markets performed well due to being oversold in 2024. That was especially the case for the Latin American bourses, Mexico, Brazil. Europe bourses did especially well in the first half of the year, reflecting one of the easier rotations out of U.S. stocks amid hostile U.S. tariff moves. Turkey is at the bottom of the ranking, mainly due to political instability and challenges with the lira. India remains under pressure, reflecting military tensions with Pakistan and uncertainty related to India being a big buyer of Russian oil. The trade policy uncertainty index is settling down a bit, though still above levels seen prior to this year. The reduced uncertainty has been a tailwind for the stock market. Stocks, of course, do not do well amid rising uncertainty. Speaking of stocks not doing well amid uncertainty, the stock markets were repeatedly and daily shocked in the early part of the year with persistent Trump posts on Truth Social and a persistent issuance of executive orders. Yet the pace of Trump social media posts and the frequency of Trump executive orders has broadly weakened month by month over the course of the year. Google Trends is showing search results for both Truth Social and executive orders have both softened. Some of the softening trend reflects actual fewer posts and fewer executive orders, and some reflects an adaptation to the new normal on the part of investors and consumers. While social posts and executive orders remain quite elevated relative to prior non-Trump presidencies, the stock market and its various sectors, companies, and geographies is seeing less of the daily shocks experienced in the first half of the year. Analysts can again focus on corporate earnings and capital formation across the many sectors of the stock market, with less focus on the theater of politics. The lower uncertainty, well, that's a tailwind for the stock market. There's been quite a bit of media coverage on the upcoming Supreme Court decision on whether Trump's tariffs are actually legal. A decision is due in the first half of next year. The betting markets are not optimistic, with only a 26% chance that the court will uphold the tariffs as legal, as shown in the chart here. If tariffs are upheld, this would expand presidential authority, and more tariffs would seem likely in 2026 and beyond. But if tariffs are not upheld, Trump can actually delay any sort of tariff reversal. That reversal could put the U.S. on the hook for hundreds of billions of dollars of refunds. The most likely delay tactic would be to allege a Section 301 violation. That would assert that the tariffs were necessary to prevent foreign dumping. A Section 301 investigation can take a lot of time, maybe over a year, and may not even conclude until Trump is out of office. If Section 301 does prove fruitless, the next step would be to assert a Section 232 violation. That's a threat to national defense. Beyond Section 232, there's also Section 338, the Smoot-Hawley exception, and then there's Section 122, which is a problem with our balance of payments. Our read here is that tariffs will likely remain for the remainder of Trump's 3 years in office, regardless of the Supreme Court decision. Beyond 2028, well, that will depend on Trump's successor. A curious trading anomaly has been rearing its head over the course of the year. Stocks have been seeing much bigger reactions to small positive or negative developments in earnings calls. While the concept of overreaction to earnings has been around for decades, the size of the overreaction is now nearing record levels. In the third quarter earnings season, stocks in the S&P gapped higher or lower by an average of 6.8% in the 24 hours after reporting earnings. That's nearly triple the size of the earnings reaction in the first quarter. And some individual S&P names have gapped as much as 30 or 40% higher on a simple earnings report. These are crazy single-day moves. Some have suggested that today's concentration in mega-cap names and fears of portfolio concentration are spiking smaller stocks when investors sell those big liquid mega-cap names to rotate into smaller, less liquid names. Perhaps that's a factor, but it appears the real culprit here is something we have alluded to in our prior video update, algorithmic herding. Indeed, this topic is one of the hot topics in the quant world, where everyone is now using the same new ChatGPT AI models embedded in their Python libraries, which all converge on the same solution at the exact same time. We suspect this quirky new development will eventually pass. Quants are not immune to the idea that you cannot outperform by doing the same thing as everyone else. We'd now like to move on to part 2 of our slideshow, the economy. We'll begin by looking at GDP growth in the developed world. This table shows quarterly GDP growth rates over the last few years for most developed countries of size in the world. Latest data for most of the world is Q3 in the right-hand column. And as of Q3, the world economy had really no major weaknesses, but also no major strengths. There are a few red patches, though most seem anomalous and unlikely to persist. Japan had a pullback in capital spending, which appears to be just a timing issue. Switzerland was a tad soft with some tariff-related export softening, but that too seems likely to reverse soon. Most countries in the developed world are moving forward as of the most recent data. U.S. GDP may have lifted nicely from the small 0.5% contraction in the first quarter to a positive growth in Q2 and in Q3. But much lies below the surface, as this chart shows. Indeed, there was a massive swing in the trade deficit as businesses tried to front-run the tariffs by triple and quadruple ordering imports in Q1 and then freezing import buying in Q2. The import swing essentially rendered the GDP figures meaningless in Q1 and Q2. A better way to guess at the economic vitality in the U.S. is to look at consumption, the largest component of GDP, and a component that is not really touched by the tariff front-running. Consumption is shown in this chart in light blue. Consumption grew 0.3% in Q1 and 1.1% in Q2. We do not yet have the underlying data on Q3, just the headline number. Seems likely that consumption will again be modestly positive, but hard to say where imports and exports will land. One of the biggest drivers behind GDP in recent quarters has been the AI infrastructure spending. Indeed, the chart on the left shows AI infrastructure spending adding about 1% to GDP in Q1 and Q2. If you exclude the import-export noise and exclude the AI infrastructure spending, U.S. GDP growth would actually be fairly close to zero. In other words, without the AI infrastructure spending, the U.S. would be skirting a recession. Some pundits have started asking the question, are LLMs like ChatGPT now too big to fail? We'll leave that as an open-ended question for now, but might return to it in future video updates. The Fed is concerned about both signs of rekindling inflation as well as signs of possible economic stagnation. On this latter concern, here we see the monthly ADP employment report, and the last 6 months have not been so great, with 4 of the last 6 months actually seeing net job losses. Job losses have been especially acute in the professional services and in manufacturing. This has been partly offset by job gains in education and in healthcare. We would note that the ADP report is not the usual way we rely on employment data, but the government shutdown has delayed the data from the usual source, the Bureau of Labor Statistics. On the one hand, inflation is lower in most regions of the world compared to the 2022 post-COVID spike when global demand began to recover, yet global supply chains were still not fully recovered. On the other hand, inflation has bounced in most regions of the world since bottoming earlier this year. Granted, the inflation lift has been modest, from about 2% in the developed world to the present level of about 3%, but this is what is keeping central banks from cutting rates too quickly. Why has inflation bounced? A few things. Well, there are lagging industries like utilities that are just now getting around to overdue price hikes. Among consumers that are not economists, there's a persistent belief that inflation is still a problem, even when it dropped to 2.3% earlier this year. And then there are all the headlines about the new U.S. tariffs being inflationary. So let's look at these consumer beliefs in more detail. Why do consumers think there is still an inflation problem, even when inflation dropped to a mere 2.3% back in April? This chart basically explains the conundrum. Economists understand inflation as the change in prices from the prior year. But consumers, well, they feel inflation based on overall price levels, not annual changes. As you can see in the price chart, the price changes in light blue, well, those have dropped, but the other two lines, the price levels of shelter and daycare, well, those keep rising. The differing definitions create much confusion about the state of price levels and price changes. But more importantly, the inability of consumers to understand price changes instead of price levels creates the environment for inflation to become embedded into the system. Or as the old saying goes, once the inflation genie is out of the bottle, it is difficult to get her back in. No wonder the Fed has been so cautious about a possible secondary wave of inflation. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. I'm going to highlight 5 industry discussion topics as shown here, mapping AI today versus the dot-coms, the Europe defense stocks, the debasement trade, the lumber markets, and then the new AI battle GPUs versus TPUs. Let's start by revisiting the AI story in the context of the dot-com era. We've seen these two charts in a variety of forms at least a dozen times in the last several months. It compares the tech sector prices and earnings during the late 1990s dot-com era on the left to the tech sector prices and earnings in today's AI boom on the right. As you can see on the left, the tech sector prices in green lifted hundreds of percentage points higher than the lift in earnings. However, on the right, we can see the move in the tech sector during today's AI boom is roughly matching the lift in earnings. From these charts, one might conclude that the AI boom of today is justified by sizable earnings gains, and so we're not in a bubble. But the 1990s dot-com boom was not justified by earnings gains and clearly was a bubble. Naturally, there's other considerations beyond prices and earnings, so let's look just a little deeper here. One other difference between the dot-com bubble and today's AI boom is that there were a lot of IPOs in the dot-com bubble in the late 1990s, but in the years since ChatGPT went mainstream in 2023, 24, and 25, the IPO activity has been fairly subdued. Now, that partly reflects an overactive IPO market during the 2020 and 2021 COVID-era SPAC boom, but it also reflects many of the LLMs like OpenAI just not being public companies. By keeping the LLMs out of the public market, the dot-com overvaluation question gets pulled out of the public market and stays in the private venture capital market. In other words, if there's any threat of a bubble, the threat is in the private venture capital markets, not the public markets. As you can see here, valuations for many of the high-profile LLMs and LLM-related technologies are indeed running rich. The 8 names shown here are valued at between 24 and 150 times run rate revenue, which is well ahead of where the public SaaS companies are at only 6 times revenue. Of course, private companies are trading at these enormous valuations because of incredibly impressive growth and potentially world-changing technology, and that does deserve a premium. But as with any new, highly valued technology, there is a risk. For investors in the public markets, does keeping the high-risk, high-reward LLM stocks in the private venture capital world mean that the public equity investors are shielded from what is happening in the private venture capital world? Well, not exactly. The public markets may not have direct exposure to the risks associated with the private venture capital markets, but the indirect exposure is actually quite meaningful. After all, the LLMs are huge clients of cloud and hyperscaler businesses at Microsoft, Google, and Amazon, and the funding of these LLM technologies is frequently coming from these very same companies. This creates two problems. First, we have a circularity problem with public hyperscalers funding non-profitable LLMs, which then use the hyperscaler services. It's like a snake eating its own tail. Second, we have a selective disclosure problem where the public investors only see the profitable half of the loop. But are sizable LLM losses and investments from suppliers like cloud companies really all that unusual? Not really. Indeed, the very process of capital formation depends on first investing in development and production, as shown on the chart here on the left. Losses and negative cash flow are normal, and indeed the hallmark of really great technology is commonly really big losses. That does not mean that all loss-making businesses are future successes, of course. The big opportunities, well, they come at a cost. Further, the idea of a supplier like a hyperscaler investing in the LLM business does create some level of concern about circularity. But a supplier is still a strategic partner within that same value chain and with a more highly informed opinion than, say, a pure financial investor. This puts everybody in the same boat pulling on the oars together. That's a good thing, not a bad thing. As the saying goes, beauty is in the eye of the beholder. We think there's two ways to look at this situation. For public investors, we believe that the big six large technology companies do indeed have a touch more risk than what the valuation multiples might imply, and we are a tad reluctant to compare the tech sector today to that of the dot-com era without acknowledging the structural differences today of how public and private markets break down. For private venture capital investors, the frame of reference is to other high-risk startup businesses, and by comparison to this inherently riskier startup basket, the big LLMs are some of the most compelling unicorns in years. Losses are necessary in the race for domination, but total market potential is sizable. Let's move on to our second industry topic. Will Europe defense stocks keep roaring higher? European defense stocks have done very well this year, outperforming most of the high-profile AI stocks even. Rheinmetall of Germany has been one of the best so far this year, up 193%. We've also seen strong performances from Saab of Sweden, Thales of France, and BAE Systems of the UK. Why has there been such a tailwind here? Seems Europe defense spending is rising sharply with the projections for over 100% growth between 2023 and 2026. There's three main drivers here. First is that the U.S. has become less reliable as a NATO partner. Secondly, Trump has been reluctant to spend money as the world's police force and wants Europe to pay its fair share. Lastly, Europe's eastern flank, well, it's more exposed to the effects of Russian aggression. With the big military buildup in Europe, there's some categories of spending that are more sought after than others. Anti-drone technology seems to be highest on the list, but ammunition and munitions are not far behind given the depletion levels, especially near Ukraine. Armored vehicles are also on the sought-after list, as well as satellite and space technology. In the center you can see one notch below of priority, the naval systems and cybersecurity, and on the far right you can see legacy aircraft and non-precision artillery, probably deferrable purchases at this point. In the mid to large cap space, there's really only 6 pure-play European defense stocks, as listed here. There's also a handful of European conglomerates that have smaller defense subsidiaries. It's clearly a correlation between the names that have done well, or that is the names that trade at high valuation, with the companies with revenue that's dominated by the sought-after defense products. Saab, for example, trades at 38 times earnings. It's the richest in the group, but Saab has a disproportionate exposure to that sought-after anti-drone technology. In contrast, BAE Systems trades at only 19 times earnings, just below a market multiple. It's a fairly broad-based defense company with less concentration in the sought-after technologies. The ETF industry has risen to the occasion and launched several Europe defense funds in recent months. The purest play on Europe defense is the Wisdom Tree ETF under the ticker WDEF. We've actually taken a small position in the Wisdom Tree Fund in recent months, which is slightly uncharacteristic for Cedar River, where we usually own the underlying stocks. But the Wisdom Tree Fund seems tight enough for proper exposure without going into too much dilution into parallel industries or geographies. Moving on to our third industry topic, the debasement trade. Let's talk about gold. We touched on this topic in our third quarter investment letter. This chart gets a lot of circulation among gold fans. The chart shows that foreign central banks now own more gold than U.S. treasuries. That seems to imply that the U.S. dollar is done for as the world reserve currency. That seems to resonate with news flows over the last year. The U.S. is increasingly hostile as a trading partner with high tariffs. Capital flight away from the U.S. dollar has moved into other currencies, and U.S. debt problems continue to increase. And there are signs of political favoritism toward weak dollar industries such as red state-based oil and farming, and away from strong dollar industries in those blue state technology and consumer companies. Gold stocks have roared higher with the GDX Gold ETF up 184% in the prior 2 years. By comparison, the Magnificent 7 large tech stocks were up a mere 107% over the same period. By comparison, the S&P 500 was up 53%. Usually when a sector roars ahead like gold has, the investment banks show up with tons of deals, typically stock offerings and merger partners. That also means more analyst coverage and more publicity. But while stock offerings have increased, it is not as much as you'd think. It seems the SPAC boom of 2020 and 2021 was much more banker intensive than the current upcycle. Why is that? It's possible the debasement trade is, well, fake news. Indeed, most of the increase in central bank reserves is not due to central bank buying, but rather it is due to the price of gold going higher. Foreign central banks actually have a slightly lower volume of gold when measured in ounces instead of dollars. The gold prices have risen, of course, because speculators are buying. And speculators are buying because, well, hostile U.S. tariffs, capital flight from the U.S. dollar, and U.S. debt problems. If this is a mere speculative bubble, does that mean that the bubble will soon burst? We think gold, while clearly frothy in here, is likely to remain elevated for the near to medium term. The narrative just seems too rich for speculators to back out anytime soon. U.S. as the trade enemy, struggling with debt and capital flight. That said, we doubt that actual debasement will ever take place. Central banks will remain fiat, and central banks will be resistant to buying gold into such a speculative bubble. So, in summary, gold, while still frothy in here, that's probably going to stay elevated for the near to medium term. Our fourth industry topic is about the lumber industry and explores the recent drop in mortgage rates, but without the usual surge in lumber prices. Lumber prices on the left are back near their lows for the year. Usually some softening in mortgage rates spurs lumber wholesalers to stock up, thereby lifting lumber prices. But mortgage rates in the chart on the right, well, they've been softening all year, but with little persistent upward movement in lumber prices. Lumber and timber companies have seen stock prices soften over the course of the year, with price declines from as little as 3.1% for Potlatch Deltic to as much as 55% down for Trex. The timber REITs, Potlatch, Rainier, and Weyerhaeuser, have held up a little bit better than the lumber C-Corps like Louisiana Pacific, Boise Cascade, and Trex. That likely reflects the lower beta of the dividend-paying REITs. Still, both groups are down. Are investors dumping their timber and lumber companies in order to buy into sexier artificial intelligence stocks? Why the weakness? The timber and lumber businesses are strongly tied into the home construction business, especially new home construction, though to a lesser extent repair and remodel. We seem to have some headwinds within the housing market. On the left you can see the inventory of homes for sale, which softened during COVID due to high demand, but then softened again when mortgage rates shot up in 2022 due to low supply. Now since 2022, the inventory numbers have been creeping higher. Now the chart on the right shows existing home sales, and you can see how home sales basically dried up after the 2022 mortgage rates, and that really hasn't gotten any better. But if existing home sales remain weak, yet the inventory of homes for sale is increasing, where is that increasing inventory coming from? Well, it's coming from new home construction. Indeed, if you look at the inventory of just new homes, a very different picture emerges. Here we have the inventory of just new homes for sale, and it appears that inventory is lifting, well, to problem levels. We're nearing the inventory level of the 2008 Great Recession, a recession induced by overbuilding related to the overissuance of subprime mortgages. That suggests a challenge for the future for timber companies and for lumber companies, even with some level of mortgage relief. It's worth revisiting the fact that since COVID, the housing cycle has been anything but normal. And in particular, the mortgage lock-in effects have been dominating economic outcomes unlike in any prior cycle. Over half the housing in the U.S. locked in low mortgage rates during the early COVID years of 2020 and 2021, the low shown here on the adjacent chart. But post-COVID inflation has pushed mortgage rates up to 15-plus-year highs. And one huge surprise here was that the home builders like Toll Brothers and D.R. Horton, well, they actually thrived during this high mortgage rate period, the opposite of how home builders have behaved in prior cycles. Well, what was different this cycle was the mortgage lock-in was so profound that there were effectively no existing homes for sale. The only way to buy a home was to build a new one. What a surprise. But now we've had 2 to 3 years of high building levels, and the inventory of homes for sale has escalated, and the inventory of new homes is now pushing to problem levels. Does this mean we have another big surprise in front of us? After all, the normal way to fix a housing down cycle is with lower mortgage rates. But it's possible that lower mortgage rates instead releases a pent-up inventory of existing homes. The lock-in gets unlocked. We're intrigued at the lower valuations of the timber and lumber stocks, but we think it's still a tad too early to step into these names just yet. From a long-term perspective, the timber companies are trading fairly close to their net asset values. And timber, well, that's a fairly liquid asset class. It's a really great asset to invest in. The industry highlights that U.S. housing stock measured on a per capita basis is actually near a 10-year low, and also much of the existing housing stock is aged and in need of remodel or repair. But earnings estimates have been dropping hard this year, and the down cycle seems hard to avoid given the inventory headwind. Meanwhile, sexier artificial intelligence stories seem likely to draw capital. So we'll likely revisit these names, though maybe over the next few quarters. Let's move on to our fifth and final industry topic, again revisiting the AI story, but looking more specifically at the recent headlines around the chip industry and how TPUs at Google and Broadcom stack up against GPUs at NVIDIA. In the fourth quarter so far, NVIDIA stock has been tracking the S&P fairly close, within about 1 or 2 percentage points. But Google and Broadcom stocks have been on a tear this quarter amid the publicity around the newly co-developed AI chip, the Tensor Processing Unit, or TPU. Investors are wondering if this means that NVIDIA no longer has the monopoly on AI chips. NVIDIA's GPUs are the backbone of AI today, and NVIDIA's CUDA ecosystem has over 90% market share. GPUs and TPUs are different architectures and with different attributes. The NVIDIA GPU was originally designed as a chip for video gaming, hence the name Graphic Processing Unit. But the matrix math embedded in video game chips proved highly functional for AI uses. TPUs, in contrast, are ASIC chips that have been optimized for matrix or array-based math. If you ask AI about strengths and weaknesses, the response seems fairly consistent that GPUs are great for training, but TPUs are better at inference once the training is done. NVIDIA has done an admirable job cementing its existing clients into its ecosystem by rewarding loyalty and raising switching costs within the CUDA ecosystem. But LLMs are certainly aware that there is risk to a sole source supplier relationship, so early movement is already happening and at scale. The new TPUs are clearly drawing interest from the LLMs. Of course, Google is arguably the biggest LLM to step up. Google is also a co-developer of the TPU, so folks tend to discount that, but Anthropic, which has the Claude LLM, is an early adopter with a sizable $21 billion deal. Others that have stepped up include Meta or Facebook, ByteDance or TikTok, plus others that remain undisclosed. Peter Lynch used to say that stocks are about 3 things: number 1, earnings, number 2, earnings, and number 3, earnings. This raises the question about who sees more incremental profit from TPUs. Is it Google or is it Broadcom? Google essentially owns the chip and its design, and Broadcom is in second chair as a glorified contract manufacturer. But Google is a huge company, and a hugely successful chip, well, it's not going to move the needle as much as it will for Broadcom. And Broadcom is not exactly small, but the TPU will be a greater portion of revenue. Our read here is that Google is the low beta play on TPUs, and Broadcom is the high beta play on TPUs. We actually like both names, though we only own Google at present. Before we conclude, we have one more slide looking at the stock market over the long term. This chart looks at broad market-dominating investment themes over the decades going back to 1960. The chart provides context for the AI boom that we're presently in the midst of. Broad themes do indeed seem to shift about once a decade, although just because a theme switches does not mean the theme from the prior decade collapses. For example, during the emerging markets and commodity boom of the first decade of the 2000s, Microsoft stock, which is clearly not an emerging market or a commodities company, well, it traded off in the first year amid the dot-com bust, but it actually modestly outperformed the S&P 500 for the rest of the decade. What will be the next theme after the present AI boom? Hard to say. Maybe another weak dollar-induced rally in emerging markets and commodities, or maybe a rally in overlooked small caps, or maybe there's a Rust Belt renaissance in the U.S. industrials. Stay tuned. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.